Hi all, so today we are going to learn PE ratio, right? It is used in the fundamental analysis of the stock and whether to find whether a particular stock is overvalued or undervalued. So particularly talking about the PE ratio, the full form of the PE ratio is price to earnings ratio. So in this ratio we are taking in consideration two things. First one is price and the second one is earnings. So price basically means the market price of the share. For example, the particular share is trading at rupees 100 at NSE or BSE. So this is the price of the particular share. And the second one is the earnings are basically earnings per share. So how the earnings per share are calculated? Earnings per share are calculated as total earnings divided by total number of shares, right? So this is what I mean EPS, so earnings per share. So for example, the total earnings of the company are rupees 100 crore and the total number of shares are 10 crore, then the earnings per share will be rupees 10 per share. Okay, so this is earnings is rupees 10 and the price is rupees 100. So what is PE ratio? So the formula for the PE ratio is, so share price per share, the price per share, and divided by EPS, that is earnings per share. So share price divided by earnings per share is known as the PE ratio. So for example, in this ratio, in this example, we have the share price of rupees 100 and the earnings per share are rupees 10 as calculated earlier. So the PE ratio, will be 10. So particularly when we talk PE ratio, it is in years. Why? Then we have to understand the concept of PE ratio. What is the rationale of the PE ratio? Okay, so what PE ratio tells us? First we have to understand this. PE ratio basically tells us that in how many years our share price will be recovered through or by earnings per share. In how many years our share price will be recovered through by the earnings of the share. So here are 10 years, means after 10 years our share price of rupees 100 will be recovered, as we are earning 10 rupees for 10 years. So the price of rupees 100 will be recovered after 10 years. So this is the logic of the PE ratio. So means this period lower the better. So right, PE ratio is lower the better, is good for us. When the PE ratio is lower, then we can say that the share is undervalued, and when the PE ratio is higher, let's suppose 30, then the stock is particularly overvalued, right? So PE ratio is lower the better, right? So we find the importance of PE ratio in finding the value investing stocks. So value investing is basically we invest in the undervalued stock. Okay, so we can find the undervalued stocks by finding the lower PE stocks. So the stocks which have the lower PE are the undervalued stocks generally. Okay, so then PE ratio, sometimes PE ratio can be misinterpreted as well. Then how? Okay, so we have to consider this as well. First of all, PE ratio, the price and the earnings. The price is today's price. Okay, and after that the earnings of the share are the past earnings of the share. But we have to calculate the PE ratio, we have to estimate the PE ratio as in the future date. So the future earnings can be very high. Suppose in this year our earnings were rupees 100 till now, But let's suppose now our earnings will be 200 crores and the number of shares as earlier it was 10 crores. Okay, so here EPS will be rupees 20. So earnings per share will be 20, and if the market price of the share is rupees 100 as above, as taken as above, right? So if the market price is rupees 100, so then PE ratio, our new PE ratio basically rupees 100 by 20, so that is what, 5 years. So here the PE ratio changes and it came to 5, so it is better because our earnings are much higher, means earnings increase, so that's why PE ratio decreased, and hence it is the stock which is undervalued. So this is good stock, we can say at particularly. But these are the future earnings, so means ultimately we have to consider the future earnings. So if the growth prospects, right, what I mean to say, if the growth prospects of the company, future growth prospects of the company are very good, then there may be some instances where the PE of the ratio is already high because the earnings of the company are rising in the future, so that's why the PE might be higher. So we have to consider this as well. The merits of the PE ratio are we can find the undervalued and overvalued stocks easily. Just we have to consider if the future, first of all we have to understand that if the future prospects of the company are very good, then the PE might be higher, and if the future prospects of the company are not that good, then the PE might be lower. But this company is good one and this company is bad one. First, lower PE doesn't always means the company is good. Sometimes it may be bad because the future earnings of the company are going to get down. And if the PE is higher PE, still the company is good because the future earnings of the company might be rise in future. So it is always not true that lower the PE, high better the stock. Sometimes it may be misleading as well. So I hope you like it, but the summary is ultimately PE ratio is price to earnings ratio, and lower the better, and it may be misleading in some cases as well. Formula of the PE ratio is share price divided by the earnings per share, right? Hope you like it. Thanks for watching, and if you like it, please like it. Thank you. Bye.